In this episode, we will examine how investor overconfidence in their own abilities, as well as reliance on the notion that, quote, this time is different, can contribute to the persistence of financial bubbles. Additionally, we will address several macroeconomic factors that increase susceptibility to the Icarus Effect. Investors who are overconfident frequently believe they can predict market trends or pick winning investments with certainty. In the early stages of market bubbles, these initial profits often strengthen their confidence and lead to confirmation bias, where they only consider the data that agrees with their belief. This pattern is known as the, quote, Icarus Effect, named after the Greek myth where Icarus ignores warnings and suffers the consequences by flying far too close to the sun. With ongoing success, investors may overlook risks and warning signs, dismissing them as mere fear, uncertainty, and doubt. Such attitudes make them more susceptible to the recurring ups and downs of financial bubbles. Strong economic growth often leads market participants to become overly confident. Consumers and investors might believe that growth will continue indefinitely, prompting them to borrow, spend, and invest without fully accounting for the possible risks. In the same way, lenders may ease their credit requirements or pay less attention to evaluating borrowers, trusting that positive economic growth will protect them from mistakes. Japan in the 1980s exemplifies this trend. The decade of the 80s marked a notable period for Japanese equity and property investors. As illustrated by this chart, the Nikkei 225 in blue increased by over 492% in the decade, averaging nearly 20% annually. Housing prices followed suit in white, climbing approximately 119% before reaching their peak in '91, which occurred 2 years after the equity markets. Declining interest rates facilitated robust economic growth and eased access to credit. This environment contributed to substantial inflows into equities and real estate, fostering market overconfidence and propelling asset prices higher. The bubble burst at the start of the next decade when the Bank of Japan significantly raised its policy rate. Subsequently, both the Nikkei and the Japanese residential market each lost more than 90% of their value prior to bottoming out in the early 2000s. It was not until 2024, 35 years later, that the Nikkei returned to its previous high from '89. This excessive confidence, known as the Icarus Effect, led investors to assume growth would never end. But like many asset bubbles, even a small change was enough to reverse this trend and expose investors to significant losses that took decades to recover. Thank you for your time today. Please join us for our next episode where we will discuss loss aversion and bag holders, why we just can't let go.